Hi, how invest here? Today I'll be talking to you about how I invested in NSF and how I use it to help build my wealth. So, what is NS? It's a stand for National Service. It's a 1 year, 10 months, or 2 years program which all male Singapore citizens or permanent residents have to serve after they graduate their high school, polytechnic, or IT. So, in this video, I'll be going through what are the ETF, what's an ETF, what is DCA, and what's the two ETF I bought while I was in NS, and how to start. Also, basically in this video, I'll be telling you about how you can use NS to help grow your wealth and possibly up to $1 million when you retire. So to start off, what's an ETF? An ETF is an exchange traded fund. It's basically a diverse bucket of stocks that is inside a portfolio, which comes at a low fee. So why do people choose ETF instead of individually picking stocks? Firstly, if your stocks fail, is bankrupt, you lose the company and you lose your money. But instead, one fail, it's a huge bucket, so there are many other companies that will help you keep your portfolio intact and your money still be around to be invested. It's simple and you don't need to do hours of research. And for example, like the S&P 500 ETF, you just need to buy 500 companies and just buy it. And just need to buy one ETF, you don't need individually buy all 500 companies, and it saves you a lot of time on broker fees, exchange fees, and trading fees if you keep picking stocks and buying and selling. Basically, it saves time and money. So, what is DCA? DCA stands for dollar cost averaging. It is an investment strategy where you invest a fixed amount of money into a specific asset, such as a stock, ETF, or Bitcoin, at a regular intervals, regardless of the price. For me, I place $500 a month into an ETF, which I'll be going through later. Why DCA helps? It's easy to start. It doesn't rely on any price point or signals. Like you don't need to read the charts, and you also don't need to wait for the price to drop. It's easy to understand basically, and helps to build wealth. So first, the first ETF I'll be going through is SCHG. SCHG owns about 250 of the fastest growing large cap US companies. There's a low fee of 0.04%, low dividend, as it's a growth ETF. It doesn't really concern that dividends need to be there high or low. It's high growth and it's large companies, and it's much better ETF as compared to the QQQM or VUG, as compared to its fees and the way the management structure to choose the 250 companies. So as you can see here, this SCHG as of 3rd June, yes, for the 1 year it went up for 14%. SCHG top 10 holding makes up about 60% of its portfolio. Even though its ETF is diverse, this still quite concentrated, especially into the tech sector. As you can see, 9 of these companies are in the tech sector, except for Eli Lilly. So things to take note. Or you can choose a safer option. In my opinion, is a safer option, VOA or CSPX, which just tracks the S&P 500, the largest 500 US traded companies. It has a low fee of 0.07%. But you'll ask, how? Isn't there ETFs with lower fee? There is. However, a lot of these ETF are US domicile and are not Ireland domicile, meaning for Singaporeans, we are given a 30% tax by the US government for dividends. But this, since it's Ireland domicile, is only 15% dividend tax. This ETF helps us save a 50% less off on dividend tax as compared to VU, SPYM, and SPY, if many of you have heard for. But one thing you have to note for these two ETF, since it's Ireland domicile, it only can be bought on the London Stock Exchange. And the broker available is IBKR, Saif, Saxo, and many more that I did not list here. So you can see UAE has a higher return for 1 year. You can see, at least for this, the top 10 holdings only makes up 40%, but it's still quite concentrated in the tech sector. And 60% is the other 490 companies. You can see here how it works. So, comparing the two ETFs that I have chosen for my portfolio, SCHG may have higher returns, but please note that SCHG also is more volatile. This is from 2010 for SCHG, and this is another S&P 500 ETF which I chose. You can see when during the 2022 2021 drawdown, 2022 drawdown, SCHG dropped so much more as compared to the S&P 500. And yeah, just take note that SCHG is more volatile. But if you have a higher risk appetite and maybe you want a higher reward, SCHG may be the ETF for you. So how I started investing as NS. When I first joined my national service, I was being awarded $790 as allowance per month. But obviously, as you up rank or go into your service term, you get paid more. I label down some of the possible pays you may receive and the total amount of money you can earn. You can see if you become an officer, you get $32,000, and if you're just a recruit all the way, it's just $18,960. So for me, I decided I'll put about $500 a month into ETF, just cause I felt that $290 a month for me to spend on weekends is more than enough. That equated to about $60 per weekend, Saturday and Sunday, maybe $30 a day. And then I'll get, so after my total of 24 months, I'll have $12,000 invested. So how I started, for me, I chose Interactive Broker as the broker I recommended just now. Its fee ranges from $2 USD to about 4 USD. It can auto dollar cost average, as you can see here. The dollar cost average, if you use the recurring buy, you can set it. You can choose monthly, you can choose weekly, you can even choose daily if you want to. The fees are much lower. And then you also can buy VUA traded on the London Stock Exchange. Basically, all your ETF and all your stocks can be included in Interactive Broker. This is not sponsored, by the way. I just really like this broker. And lastly, one thing important is, for me at least, I'm planning to hold the ETF for about 50 years. And I felt that Interactive Broker has a very strong track record on have it being around for 50 years. The chances of it being around 50 years later is higher than a lot of the brokers, at least from my point of view. And that's why I chose it, even though its fee may be a bit higher than majority of the broker out there in Singapore. So how the $500 will grow? As you can see, it doesn't look much. Just 2 years later, if we account for the 10.2% average stock market return of the S&P 500 from 1957 to 2026, we have about $12,612. But let's say if we hold this $12,612 for another 45 years or until we retire, this is how much we will have. Close to almost $1 million. And that's with not even adding a single cent more. Here, 65 years old, example retirement age, you have about close to $1 million. This is a huge bonus on top of whatever retirement sum you have saved on your side, or even your house and your CPF for Singaporeans. And let's say if I was even more passionate and I continued investing $500 per month, even when I go university or when I start working. So let's say we're considering investing $500 more per month for the next 45 years or until 65 years old as compared to the scenario just now. We have accumulated up to $5.59 million. I understand that $282,000 is no small feat, but think about how much it ballooned by. This is the magic of dollar cost averaging, and if it compounds at an annual growth rate of 10.6% as from the track record of the S&P 500. This is a lot of money, but of course there'll be inflation. We must account for inflation. Maybe this won't be as much as in the future as current times, but $5.5 million, I'm pretty sure in the future it's still worth more than if you have just put $500 a month into a bank account or into government bonds. So to end this video, I would like to say some warnings and things to note before you start investing and putting your money into ETF or whatever. See, you must think about holding long term. Don't expect fast gain. For me, I did not, and that's why I do not dabble into options, meme stocks, or crypto. As firstly, I don't have enough time and knowledge, and those for now don't interest me. Secondly, I feel you should build your saving first. Having a saving is best, so you can maybe, if you need to pay off your school fees, pay off small things you want to buy, having a savings first is still important, as then investing is secondly more after. And thirdly, you don't need the money. You must account for not needing the money. The market can remain flat for 10 years. Please note, from 2000 to 2009, the market was a flat line. Then 2009 onwards, it went up a lot. So you must note that you minimally must hold it for 10 years. For me, I'm holding it for 45 years, as shown in the previous chart, I plan to continue investing $500 a month. Even now, when I'm studying, I continue investing $500 a month. And lastly, be able to stomach losses. Be ready for market downturns. If market goes down, just continue dollar cost averaging, and please look on the bright side. You're just buying more ETF at a cheaper price. And if you think long term, this is a better deal. And just continue dollar cost average. In summary, I hope this video has been informative to you, and yeah, learn something about how to make full use of NS and the allowance they give you. Thank you.